I have to start off by saying I found the creation of this episode both challenging but also rewarding. Why? Because I didn't get the results I expected. But whenever I get results that don't match what I thought, I usually get quite excited, because the analysis that follows often leads to a new learning experience. And I've been through enough of these in the past to know how much a trader can benefit from these. And so, if anything, this gives me the ideal opportunity to share that process with you. And I'll do that straight after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. As I said in the introduction, whenever you get results that you really weren't expecting, this provides an opportunity for further analysis and learning something new about the way the markets work and how strategies can be used to exploit those movements. Now, in this series so far, all of the results I've obtained were pretty much in line with what I expected, until now. Now, if you're coming into this for the first time, you can find a link to the whole playlist with all of the episodes in the series in the video description. But let me summarise where we got to. These are all equity charts using the stochastic RSI indicator. The yellow equity curve is just using signals from the indicator and nothing else. The red equity curve uses an open filter that only allows trades to be opened at certain parts of the day, and that was based on analysis that we performed. And then the green curve here also incorporates what I call equity flow analysis, which I implemented in the previous episode, so be sure to watch that if you haven't already. Now, I was working through this exact same process for the standard RSI indicator. And so we had the yellow equity curve here, which was using just the RSI indicator on its own, and then the red equity curve where we managed to get a small profit when we implemented that same open filter based on the time of day. And at this point I pretty much decided that the stochastic RSI operated much better as an overbought, oversold indicator than the standard RSI did. And as you can see, the results here are nowhere near as good as we got when we did use stochastic RSI. And so this episode was to produce that third equity curve, which incorporated equity flow analysis, but actually I never got that far. As I said before, I got unexpected results which caused me to do some further analysis, and so instead of producing that third equity curve, I'm going to share the findings of my analysis with you today. And there's some really good learning to take from that. So if you remember, in order to perform equity flow analysis, we need to run a backtest here, and while that backtest is running, we need to write out equity details every hour throughout the whole backtest. So let's set that off now for the RSI indicator, and we'll come back to this when it's completed in a few moments. Okay, so now that that's finished, we can take a look at the CSV file for the equity history. And I'm not going to explain this in any detail because I did that in the previous episode, but I'm going to run exactly the same analysis now using a pivot chart, and I'm going to look at how the equity changed for each hour of the day on average. You can see that a lot more clearly on a pivot chart. And I explained last time that the final value here and the first value are nothing to do with the performance of the strategy, but rather just an anomaly because of the fact that spread increases overnight, having a negative effect on any open positions. And then when that spread decreases again, it has the effect of causing the open positions to go back into more profit, giving the illusion of this bar here. So really these first and last values offer no value, so I'm simply going to remove them from the analysis. Okay, so what we get now is nothing like we got with the stochastic RSI analysis. That had a really nice pattern to it, and you could see how the equity flow was being driven by the opening and closing of the Asian, the European and the US sessions. But looking at this, it's more like a completely random set of metrics. And this is not what I was expecting. So in order to understand this better, I went all the way back to take a look at the indicators with the parameters that we're using in this analysis. So let's just make this a little bigger. So the blue indicator that you see here is the standard RSI using 14 periods, and the yellow is the newer stochastic RSI. Now, we've studied the differences here before, and we made a prediction that the stochastic RSI would produce far more trades than the standard RSI. And of course, we proved that that was the case, because the stochastic RSI reaches the overbought levels and the oversold levels much more frequently. And so we were expecting to get more trades and we did. But there's another effect that I hadn't considered previously, and that is the duration of the trades that are produced. And I didn't think that was as important until I started to do the time of day analysis and realised that I was getting more random results when we looked at the equity flow. So with the stochastic RSI, based on the rules that we've implemented, a short trade would have been produced when the indicator was in this overbought region, and it would have closed as soon as it reached the oversold region, and vice versa. Here, a long trade would have been created here and closed here. So the duration of trades is really quite short. But let's compare that to the standard RSI. Let's say that we took a short trade here when the indicator became overbought. We wouldn't have closed that until all the way over here 4 days later. Now, at this point, if we'd opened a long trade, we wouldn't have actually closed that at all until this point here, 14 trading days later. So this prompted me to now look at this in a lot more detail to try to understand the implications of time of day trading more. So here I have two files that contain all of the trades that were opened by the standard RSI strategy and all of the trades that were opened by the stochastic RSI. Let's take a look first at the RSI, since that's what we've been concentrating on in this episode. So I'm going to create a pivot table of all of the trades, and I'm going to look at the trade duration in hours and perform a count of the number of orders that were performed for each of those. Now, if we just create our pivot chart here, this doesn't provide us with very much information of any use, and so we need to group together these values So I've grouped them into hour segments. So for example, we had 5 trades that lasted between 0 and 1 hour. We had 8 trades that lasted between 1 and 2 hours, and so on. Now, because this distribution chart has so many segments, I think it's worthwhile using bigger buckets here. So I'm going to split them into 6-hour buckets. So this now gives us some really valuable information. The first 4 bars here are all the trades that opened and closed within 24 hours. Everything to the right of this, which of course is the vast majority of the trades, were open for longer than a day. Now let's compare that with the stochastic RSI. So we'll do the same thing. We'll insert a pivot table, choose the duration, and look at the count of orders, create our pivot chart, and again we'll need to do a grouping here. So I'll group by 6 hours, the same as we did for the RSI, but here, because we have far fewer buckets, I think this would benefit from a smaller size, so I'm going to group it by 2 hour buckets. So as you can see, this is a completely different picture. This is the 24-hour line right here. And so you can see that there's a large proportion now of the trades that open and close within a single day. And there are far fewer as a proportion that are open for longer. And so I started to consider how this would impact the time of day analysis that we've been performing, and straight away the answer was clear to me. Last time, when we looked at the stochastic RSI, we could see that that benefited greatly by opening in one session, the Asian session, and then allowing the mean reverting nature of the market to help those positions in the European session, and then closing the trade. And I think the strategy benefited from that because the stochastic RSI overbought oversold indicator moves very quickly. And so it was very much in line with that time period of 2 trading sessions. But the natural frequency using RSI is much, much longer. So if left to their own devices, trades, as we can see here, span many days, then they will be subject to multiple Asian sessions, multiple European and US sessions. And so by attempting to look for patterns on a much shorter time frame really was futile, because we'd be cutting those trades far shorter than the overbought and oversold signals themselves. So let's take a closer look at some of the key learning and takeaways from this analysis. Firstly, the equity flow analysis side of things, if we're looking to implement a close filter, will only be effective for intraday trade durations. And because the stochastic RSI matched that criteria, that's why we saw that strategy benefit from this greatly. But more specifically than that, I think that equity flow analysis will be most effective when the frequency of signals from an indicator broadly match 2 sessions. So for example, the Asian and the European session. And when that's the case, it means we can take maximum advantage of those mean reversion characteristics that we see when one session turns into another. And again, the stochastic RSI was able to take good advantage of that. So, in hindsight, how could the comparison of the standard RSI and the stochastic RSI have been done better? And thinking of that question raises a really important point. In order to improve as traders, we have to make mistakes, and we have to learn from those mistakes. And that's where the improvement comes from. And for me, this is one of those. So initially, I tried to keep everything consistent between the standard RSI and the stochastic RSI. And coming from a scientific background, this is a core principle of scientific experiments. You keep things consistent wherever you can, so that you can deduce true facts about the research you're undertaking. And so to me it seemed perfectly logical that we should use both indicators on the same time frame, and I chose H1 in this case. But I'm now thinking maybe this was wrong. Instead, should it have been the frequency of trade durations that I kept consistent? And I could have done that by keeping the stochastic RSI on the H1 as we did, but then using a lower time frame for the standard RSI, such as the M15 or maybe even the M5. This would have then reduced the duration between the open and close signals generated by the indicator, and they might have been better matched to the frequency of the trading sessions to be able to benefit from those in our mean reversion type strategy. So for me, this was an excellent episode in that I got some learning from it directly. Now, does that invalidate everything we've done with RSI and stochastic RSI? No, absolutely not. I'm still very much of the opinion that stochastic RSI is a better indicator than the standard when used specifically in relation to overbought and oversold signals. And at this point, of course, we weren't doing any type of time of day analysis at all. We were just relying on the raw signals from each of the indicators. What the work we did also proved was that we could dramatically increase the performance of a strategy, as we saw with stochastic RSI, when we did match the frequency of signals to those market sessions. And so I think that everything we did up until this point is still valid. And with this new learning that we now have, it means we have a way forward with RSI. So the analysis could be redone now relatively quickly with RSI on a lower time frame to see what results we got there. And of course, another advantage of that is that by moving RSI onto that lower time frame means we'll get more trades, and therefore the results will be more statistically significant. So I'd encourage firstly anyone who's been following along with this to undertake that analysis yourselves, and please do post the results in the comments because I'd love to read them. But also, in the very final episode, I may well produce my own results of this and share them with you. But before I do that, I have a number of other episodes I want to complete. The first is to adjust the position sizing strategy. So taking this from just a minimum lots strategy to a strategy that scales with equity so that we can see what effect that has on the stochastic RSI system that we've been looking at. And I'm also going to look briefly at some next steps that I'm not going to cover in detail, but are things that you would need to consider and undertake yourself if you were considering trading this type of strategy in a live account. I'm then going to cover a number of coding tutorials for functionality that I've used in this series, and there'll either be 2 or 3 episodes here. And although I'll be using MQL5, the logic that I explained is something that can be transferred to any programming language you wish to use. And then after this, I'll probably have one final episode which will look at the results of the standard RSI on that lower time frame, either M5 or M15, to see if we can get some better results from the equity flow analysis and therefore improve that strategy. If you think you have any relevant information, hints or tips about the topic of any of my videos, then please remember to comment so that I and other viewers can all benefit from your insights. Also, if you're getting value from this video, then please remember to give me a thumbs up. Now, until next time, trade safe.